Everyone.
Hi friends. Hi Kushagra.
Hello.
Hi. Okay, just checking whether the audio is okay or not.
एक मिनट रेणु का वो बोला ना। हेलो। 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 एक मिनट।
Yeah, Subhashi, you're audible.
या आई एम
Jai.
ऑडिबल ना। हाँ इट्स
Yes,
ओके।
yes. Yeah.
Yeah.
आपका मुझे कैमरे में पता नहीं है इसके ना सर इस पे करा दें नहीं तो
हैं?
इस पे करा दें
हाँ, इस पे कर दो।
आपका ये यहीं पर
Dr. Rajesh. Dr. Rajesh.
Yeah, good afternoon, sir.
Good afternoon. Should we start? Do we have everybody?
No, sir. Just give me 2 and 3 minutes more, sir.
Yeah. We have Arjun with us. Abhik is in the ministry, so he may not join, but he'll
Okay.
let us know. Indrajit should join.
Again, Rajesh, is it okay? My voice is okay?
Yes, sir. Everything is okay, sir.
Dr.
Yeah,
Charan
Charan, sir,
Singh,
please
good
continue, sir.
evening.
Hi, good evening. How are
My
you?
voice is okay?
Absolutely, we can
Yeah,
listen so clearly. So Siddharth has to join, and then
सिस्टम में वॉल्यूम है
And what about the Indralin, sir, and Vasana, ma'am, sir?
they should join. Remind कर लो जल्दी से.
Okay.
Even Abhik may join. He was in the ministry a few minutes ago, but as he comes, he will join.
Okay. Okay, sir.
Rajesh, now my voice is okay?
Yes, sir.
Yeah, thank you.
Yeah, Chan sir, I think we should start now. So,
Indranil, has
request.
Indranil joined?
फिर मैं बात करता हूँ.
No, he has not joined, sir, but he
15
is
मिनट होगा.
not picking my phone. So,
Yeah, and Upasna madam,
she is joining.
she's joining.
Yes,
And
good afternoon, everyone.
good afternoon. And has Siddharth joined?
No, sir, just 1 minute.
Just send him. He told me he will join. I'm just sending a reminder to Abhik. He should, if he can, he will join. I think, Rajesh, let's start.
Yes, sir. So now I request SC Agarwal, sir, please start with your comment, sir.
Yeah, first of all, I must congratulate ASSOCHAM for holding this bi-monthly meeting, this Shadow Monetary Policy Committee meeting, discussion on RBI monetary policy. So it's a great thing. Members are greatly benefited out of this. And it's my privilege to deliver welcome address on behalf of ASSOCHAM and EGROW Foundation. Today's session chair is Dr. Surjit Bhalla. I think he has not joined so far. And in his absence, if he don't join, then Dr. Charan Singh will chair the session. So panelists are Dr. Charan Singh, Advisor ASSOCHAM National Council for Banking and Chief Executive EGROW Foundation. And other panelists are Sri Manish Mathur, Country Manager, India Dena Bank, Doha Bank, Sri Surjit Kumar, Chief Economist, National Bank for Financing Infrastructure and Development, Ms. Upasna Bhardwaj, Chief Economist, Kotak Mahindra Bank, Sri Indranil Sen Gupta, Professor, Practice of Economics, Shiv Nadar University, Sri Abhik Barua, Chief Economist and Executive Vice President, HDFC Bank, Sri Siddharth Sanyal, Chief Economist and Head Research, Bandhan Bank, Sri Arjun G. Nagarajan, Chief Economist and Communication Manager, Sundaram Asset Management Company Limited, and vote of thanks to be delivered by Sri Vasudev Mukherjee, Assistant Secretary General, ASSOCHAM. So I welcome you all since your cooperation for every bi-monthly meeting of this shadow monetary policy. You always take the pain and attend the meeting, and members and public at large is being benefited out of this. So this RBI will declare this monetary policy meeting on 9th October. Meeting will start from 7th October itself. And this time it is likely that RBI will keep the policy rate and instance rate as it is. That means no change. This is being expected as Bank of Baroda issued a research report about this monetary policy, and in that report they have given their views that RBI will likely to keep the policy rate unchanged. Why? Because they want more clarity on inflation and growth. Since last 2 months, July and August, inflation has remained lower than 4%, around 3.5 and 3.6%. But still, RBI wanted to see it for longer term durability of inflation. They believe that up to until food prices is not stabilized and inflation is not very high in food prices, uh, inflation cannot be uh, below that 4%. And moreover, if you see core inflation, that is also stable. Monsoon is also good. Even food prices is currently it is good, but you never know the monsoon. Even unseasonal monsoon is also there. So if at the time of withdrawal, then crops can be disturbed. And if everything goes correctly, then new crops will keep the prices of vegetables at lower levels. So these are the comforts. But still, as per the report of the Bank of Baroda, RBI would like to keep rates and stance both unchanged. And
Please, Junior. Junior.
okay. And other thing, GDP is expected to be very good from 7.3 to 7.4. So manufacturing PMI, which has come down to 56.5 from 57.5 in July, and it was 56.5 in August. Vehicle sales down. GST collection is good. Direct, indirect taxes are good. Otherwise, economy is doing well. Even if US Fed Reserve has reduced rate by 50 bps, RBI is not in a hurry to reduce the rate. I think RBI is more likely to reduce the rate from December policy meeting, since as I told you in Bank of Baroda report, RBI want to look stability in growth and inflation. So other things, tractor sales have been moderated. Service sector PMI is good. So in August, RBI keeps the rate stable, and this would be the 10th time that RBI will keep the rate as it is, no change. So I conclude my remarks here. Thank you very much for giving me this chance. Thank you everyone, and thank you all the speakers. Over to Dr. Charan Singh.
Thank you very much, Agrawalji. Thank you very much for giving your perspective from the industry angle, as well as sharing with us the findings of the Bank of Baroda report. I think our next speaker, Dr. Sujit Bhalla, probably will not be joining because there's a Kautilya Economic Conference conclave starting, and therefore he was busy in that. And so he mentioned to me, but if he joins, I'll let you know and we'll have him in immediately. Dr. Rajesh, so should we first cover Mr. Manish Mathur and Sujit Kumar, then I come in? So I'll have the raw thoughts from the industry.
Yes, it is up to you, sir, but I request you
So
to
let's
take
do
a
that.
view
Let's
from
do that.
Mathur, so it is okay.
Mr. Mathur has joined.
Yes, he has joined, sir, both Mr. Manish Mathur and Sujit Kumar.
So can I request Mr. Manish Mathur to please share his thoughts?
Yeah.
Yes.
So good afternoon, everyone, and it's a pleasure to be part of this panel. So yeah, I think as Mr. Agarwal just said, I think the stance from RBI perspective seems to be pretty much a foregone conclusion. I think most people feel that there won't be any change on the rate side as well as on the stance side. I think from the bank's perspective, obviously, deposits are an issue, which I think most banks are grappling with. Credit offtake has started to or has been exceeding the deposit growth for some time. So I think from a bank perspective, I think our expectation will always obviously be to see if there is some way we can encourage, more lending through some support on the deposit side. So one of the things we felt that we could probably, I mean, or we could probably recommend is, to see if there is, RBI has in the past also allowed, a waiver of SLR or CRR on incremental deposits for certain periods of time. So maybe, that is something which the central bank could consider, so that, there is more availability of deposits with banks, and that encourages, the deployment on the asset side going forward in the longer run. I think that is what I thought initially. I thought what RBI could consider. Yeah, otherwise, I mean, I think liquidity is, I don't think there's much of an impact we feel out of the interest rate, stance that the RBI takes right now. So I don't think that's a constraint, but that would be my suggestion on the monetary policy side.
Thank you. Mr. Sujit Kumar. You'll have to unmute yourself, please. Sujit, you'll have to unmute yourself. Sujit. Dr. Rajesh, does he have a technical problem with his system? Somebody can ask him on the phone.
Yes. So
There could be
yes,
a
so
technical.
I think now we can. Who is having problems with one?
While he's trying to fix his problem, let me share some of my thoughts, and then the team will share our thoughts at the Shadow MPC. So my own view is that yes, there is some global uncertainty which has heightened in the last few days, very worrisome. And as you know, that the oil prices are going to be the first casualty because of this heightened uncertainty in the Middle East. Already there is an ongoing war in Europe, and then there is also the election in the US, the largest economy of the world. So there are lots of issues that are coming up, which are adding to uncertainty. As far as climate is concerned, that's also playing a very difficult role. Year 2023, I think, was the hottest year in the last 100 years. And July 23, I think, was the hottest day already in the last July 23 as the hottest day. So therefore, the climate is also playing a difficult challenge. Agriculture in our country is still significantly dependent on rain, and climate plays a role in it. So there is a worry that agriculture could have some stress. It has already moderated the growth in agriculture to 2% on a year-on-year basis in Q1 24-25, as compared with a growth of 3.7% a year ago, as Rabi food grain production declined on account of lower water levels in major reservoirs and river basins. So there is a little worry up there There is, as far as industry is concerned, the IIP data for July follows a consistent trajectory. Electricity is doing well, not a problem there. Manufacturing is also doing well, and mining is following its normal course. If you look at the core industries, in the core industries, fertilizers and steel are doing good, but then there is some problem in coal. There's also a slight problem in crude oil, natural gas, and cement. So there's a mixed performance that is happening in the industry sector. The fiscal sector is interesting. The GST collection has been very, very good in September, continues the trajectory again. As far as the services are concerned, the Purchasing Managers Index in March 24, the services PMI reached 61.2, which was one of the largest increases in business activities and sales in almost 14 years. The PMI has remained above 50 since for a long time now, indicating continuous expansion. The credit in the services sector has been rising nearly 20 odd %. So in the services sector, there is an improvement that is taking place. If you look at the aviation sector, the air cargo, there has been some improvement. Already mentioned by Mr. Mathur, and that is true and so well documented everywhere, that the credit growth is taking place, but deposits are lagging behind. And one of the reasons for lagging deposits has been that the money is getting into mutual funds. That's one story. The NPAs are in control, and probably we'll have the lowest NPAs in the banking industry. When it comes to prices, the global uncertainty that I mentioned, oil could play havoc. The climate can play havoc again with rain also, as well as the heat wave. The prices so far on CPI has been below 4%, but the food prices in August have been around 5.7%. Look at WPI, WPI has certainly not followed any trend. It's around 1.3 on normal all commodities. And when it comes to food, it's around 3.3. The CPI industrial workers is well below its mark, it's around 2.4. But if you look at the CPI, if you look at the WPI commodity wise, the prices are rising in some vegetables. Petrol, there has been a rise. So in WPI. So on prices, I think we do not have anything much to worry, and oil is being, of course, discussed with the Middle East. It could go to about $90 a barrel soon. That can then start playing into our price second or third run. Foreign exchange reserves of the country are solid. We are around 1 year of import cover, and I think that is something very, very robust. In this scenario, we all know that the interest rate in the USA has now been very aggressively reduced. 50 basis point, long time since such a massive cut was really introduced. The European Central Bank has also followed the same trend. Bank of England has, of course, left interest rates unchanged in their September 19th meeting. Australia has also left it unchanged, as also amongst emerging countries, China, in September 2024, when they had their meeting. In case of Russia, little different story. They have increased it. So on the interest rate, we had been matching for a very long time the US, and US has aggressively cut its interest rate. The inflation in the US is, of course, around 2.5%. In Euro area, again, around 2.2 to 2.5. And in the UK, 2.2%. That means inflation in these countries has come pretty much under control, though not exactly where they wanted it to be. As I mentioned, the price of oil is, of course, expected to rise with the crisis in the Middle East. Price of gold is also expected to rise there. This is the overall picture in which the monetary policy has to take a decision. My recommendation would be, in a country of India's size, with a young demographic population, inflation very much under control, despite the global uncertainties, the interest rates are really at its peak. In case the global uncertainties show up into the prices, there is still scope for correction on the interest rate. So I would recommend, instead of curtailing growth further, because high interest rates certainly hit growth, high interest rates also deter investment, and which show into the purchase of consumer durables. The argument that the busy season is starting and the festival season is starting, and therefore there could be stress on prices. I think the interest rates have been already so high that even if we give it a cut, this should not be a cause of concern. Rather, a reduction in the interest rates will give an impetus to the growth tendencies and green shoots, and private sector investment can then start picking up. So my recommendation would be a cut in the interest rates from October itself and not to wait until December. In case inflationary pressures or global uncertainties through the oil prices or otherwise show up, the December cut can be delayed. But the signal that should go to the market right away is that the monetary policy is growth oriented, and at the first possible opportunity that was available, a cut has been done, even if the consideration was that capital movements or differential between the US policy rate and India's repo rate, the margin. So I would recommend a cut. Let me stop here and now invite members of the Shadow Monetary Policy. I would like to now invite Sujit. Are you ready? Has your system started working? Mr. Sujit Kumar?
No, sir. He is still having some problem.
Still having problem? Then let
Yeah.
me start with the Shadow Monetary Policy members right away. I would like to invite Indraneel Sen Gupta, Professor of Practice of Economics, Shiv Nadar University. Professor Indraneel.
Yeah, thank you, sir. I would expect a cut of 25 bips in this policy. As we know that the major reason why the RBI was on hold at such high real rates was the Fed, and now the Fed itself has started cutting, taking sort of a futuristic view on their own inflation trajectory. So under these circumstances, keeping real rates so high is only an invitation to further problems in the future. If we see growth, Again, the GVA growth has been moderating, and that is actually I would say, the number to look at rather than the GDP. Inflation, of course, has, I used to say inflation was yesterday's story. Now it's become like last year or the year before's story. So I don't think that there is any concern on the inflation side. Finally, if you look at the currency, now that the Fed is going to cut, we should be cutting, if the Fed does 50, we do 25. The way we also followed the Fed in smaller steps when the Fed was raising rates. I think it's also very important to change the monetary policy stance, given that deposit growth is so weak, and they're leading to increases in lending rates even in the slack season. Again, going back to the old story of high real lending rates that eventually go and hit growth. If you see deposit growth of banks, that's largely a function of the reserve money the RBI puts in and the durable liquidity the RBI puts in, which is very, very, very weak. When people shift from, let's say, deposits to the stock markets, that's just a shift between fixed deposits and demand deposits. So basically, I break my fixed deposit, I buy maybe mutual fund units, and the money just goes to the demand deposits of the current account of the mutual fund. That should not make a difference to the overall deposit base or deposit growth. Now, last year there was a additional issue that if RBI had demonetized rupees 2000 notes, and therefore, with very low level of reserve money, you could get in, theoretically high deposit growth. That is not the case anymore. So therefore, in a nutshell, I would say that I would look at a change in stance to at least neutral from tightening, and a cut of 25 basis points in the repo rate.
Thank you, Indranil. I totally agree with you. And I thought you were right in mentioning that it is the fixed deposits which most probably move into mutual funds. That's true. Let's move on to our next speaker. Let me check if Abhik has joined. Abhik, have you joined? Okay, so I'll keep following up with Abhik and Surjit Bhalla. Both of them don't seem to have joined now. Let me continue with then Madam Upasana Bhardwaj.
Yeah, thanks, Dr. Singh. I would take it a little step on the other side, actually. I still don't think that a rate cut is warranted. Couple of reasons. I think, what RBI is looking at is durability of 4% inflation. And I think they're still not convinced that that is happening right away. So they would want to wait for a bit, and especially, right now, of course, the two inflation readings that have come, which have been very comfortable and lower than what probably RBI was expecting at sub 4%. But we very well know that that was because of favorable base effects, number one. Now, going ahead, the next two readings, because of perishable items itself, though, but they are looking to be north of 5% marginally. But yes, so the next two readings too are looking a little higher. And on top of that, we have is the recent Middle East crisis, which is obviously at some point posing an upside risk to oil prices. I mean, the good thing we can look at it is that oil prices have become less and less sensitive to geopolitical risk until now, since the Russia-Ukraine war. The correlations and the sensitivity has been weakening quite a bit. But I think overnight we have seen some kind of reaction, and we don't know which way it's going to be heading. So the scale of the war and the sustainability of that may have an adverse impact on oil prices. So this just adds a little bit more element of uncertainty for RBI to look at this point in time when they're meeting. Now, if you just go back a couple of weeks ago or so, every speech that the governor or the deputy governor has made has also, they have kind of reiterated the fact that they are looking at 4% being achieved on a durable basis. So I would still say, especially when growth at the moment, it's lower than what RBI projected for the first quarter, but it's not still at alarming levels. We're not seeing data which is still which is showing very big signs of slowdown yet. So I think in that context, they can still wait on the rates front. Agreed that Fed has acted, but Fed has acted because of what reasons with the 50 basis? We probably have to assign a political weight to this as well, political reason as the weight. Probably they would have acted with a 25 basis, but they did a 50 for political reasons. Now we don't know how this is going to shape up going ahead. So I think they can wait until December for this. But having said that, clearly the preconditions for the monetary easing or softening in their monetary policy stance is clearly set. It is there. I do expect that, over the last 2-3 months, if you look at the way liquidity conditions have existed and RBI has not done anything really to suck out that excess liquidity from the system, I think that kind of suggests, so it's a soft signal that RBI is ready for a change in the stance. So most likely, we do believe that there should be a change in stance, and it is the right time to do that. Honestly, that statement that comes in the policy statement is not really meaningful at this point, withdrawal of accommodation. It should be dropped out entirely. They shift to neutral, they shift to whatever, kind of phrase that they want to use, but they have to suggest that they are somewhere moving towards the possibility of monetary easing. So I think that softening bias has to come about, but with a word of caution, because rates is something which they might be a little more careful about before they really touch on that. Because once they begin with that cycle of rate cuts, and there's no going back on that. So I would still say that they would want to err on the caution side at this point, and probably, go ahead with some, go ahead with rate cuts from December. Depending on, of course, how the global scenario will be. Just to point out, apart from oil prices, we know that commodity prices otherwise also are seeing an inch up, right? And with China's stimulus policy, there's a possible further upside to the commodity prices. Besides that, if this near-term risk-off was to continue, then we are already seeing the pressure on rupee. So the import-led inflation could also pose a risk. When inflation is not at 4%, it is at 5% probably, then these upside risks will automatically deter RBI from immediate action. That's one of the major reasons why I believe that they will be on a pause in October and probably look at an easing starting from December. Yeah, that's it from my end.
Thank you, Upasana. You're bringing in another perspective to the discussion. I totally agree on the durability part. How durable is it going to be? But your argument is, of course, the softening can probably wait a little bit and growth. But my argument has always been, and there can be a difference of opinion, that while we are the fastest growing country in the world, our potential is much larger, and this peak level interest rates could be contributing and are not achieving a peak level growth. But yes, your arguments are quite logical. Let's move on to Siddharth Sanyal. He's the chief economist and head of research at Bandhan Bank. Siddharth.
Thank you very much, Dr. Singh. I would, in the beginning itself, I would say my expectation in this particular policy is that of no change in policy interest rates at this moment. However, I would think that this is time for them to think about toning down that stance. It's no longer withdrawal of accommodation. They should, when there has actually, when a discussion about when and how much they should cut is very much there, unless they change the stance or tone down the stance at this moment, it will be losing all its relevance. In fact, my sense is that they could have done it, or they could have considered it a little earlier also. they have delivered their last rate hike some 20 months back. Right now, on the liquidity side, also they are moving somewhat sideways. So when both on rates and liquidity, they are moving sideways for such protracted period of time, there is not too much of merit possibly in maintaining a stance which is saying withdrawal of accommodation. It possibly should be at least neutral, if not something else in the next few months. Why I'm saying that I'm not expecting, I think in terms of looking at the various moving parts in the global economy, which some of these things just now Upasana articulated very well, that the geopolitical tension is on the rise again. There has already been a lot of stimulus from China, and there is concerns of potentially inch up in case of various commodity prices, including oil. So all these factors are there, and RBI has been very categorical in terms of fighting the last mile of or the walking the last mile towards their desired zone in terms of the inflation target. At this moment, whether that is right or wrong, it's a different debate. But at this moment, all of a sudden, if they change, a possible interpretation there can be that they are all of a sudden diluting that particular stance, and whatever they had earlier said about Fed independence part, there will be an opportunity to interpret in a slightly different way. I think RBI will be cautious about those aspects. So while I expect that there should be considerations about changing the stance, I don't really expect the policy rate to change in this particular policy itself. Having said that, I'll touch upon the liquidity aspect once more. Very clearly, the liquidity, primary liquidity infusion or the reserve money expansion on the part of RBI has been very, very low for a pretty long time now. Compared to the long-term history of 12 to 15% reserve money growth on an average, if not closer to 15%, we have seen 6 to 8%. The last print was possibly sub 5%. So there is a case for thinking about slightly more primary liquidity infusion on the part of RBI. While we have seen that the money market rates haven't really faced a huge problem of late because of the low reserve money growth or because of the low liquidity available in the system. We have seen even the GSEC market also. In fact, GSEC yields rallied more often than not in the last few weeks because of various other factors. I think the brunt of the liquidity issue or lack of availability of durable liquidity with the market, that brunt of the problem has been borne by the credit market. Very clearly, bankers who are now holding possibly larger chunk of, as Indranil also articulated very clearly, that they are possibly holding larger chunk of demand deposit without being very sure that when and how much will be withdrawn. They are not in a position to really expand their credit book the way they want. So at this moment, it's very much more important that they actually get adequate amount of liquidity in hand so that they can actually cater to the good credit needs. In fact, when the cost of deposit at this moment is so high, the fight for deposit is so intense, this is actually a very potent background or a very, very, very clear set of preconditions that may lead to some kind of adverse selection on the part of the asset side managers of the banking system, because their cost of fund is going so much higher. They might actually start chasing yields, and that may lead to some of the selection of projects and some of the selections of individuals who are not who wouldn't possibly been selected otherwise. So at this moment, we think that there is the effect, it will be most effective if the central bank tries to see the liquidity scenario in a slightly different fashion, slightly more leniently than what they had been doing. And very clearly, given that the inflation momentum in general had been well under control, fiscal deficit has been well under control, current account deficit pretty healthy, it actually is in an easier situation to support liquidity than in some of the other situations. So overall, possibly that will be the most effective step at this moment. And for that, you necessarily don't have to make a big announcement. You don't have to make any big departure, or you don't have to create any headline, but you can actually just do it at your own pace and keep on tweaking according to the developments in the economy. I think that will offer a lot of flexibility to the MPC also going ahead. And that's why I would strongly recommend that. In fact, if they actually start cutting rates tomorrow, given today we are in a EBLR regime, or external benchmark link regime today in the banking system, and this is the first time we'll be dealing with that. Previously, when there was a cutting cycle, at that point in time, just about 5% of the banking system's books were on an EBLR regime. Today, more than 60% of the bank's asset books are external benchmark linked. So if tomorrow there is a rate cut by the RBI, immediately there will be a cut in the lending rates. But nobody is very sure whether there will be so much or commensurate cut or any amount of cut actually on the deposit rate side. The problem with deposit is manifold. It's the issue of some amount of money going in some of the competing asset classes have been highlighted even by policymakers, which has been relatively less discussed. A very significant chunk of money is also going for small savings directly into the books of government, and that is a clear competition with the banking system, etc. So maybe some of these rate changes should actually be can come in a slightly more coordinated fashion over the course of the next few months. But at this moment, if they actually start stepping up the liquidity infusion, not necessarily with any big bang announcement, but just in terms of their action and practice, I think that will be most helpful for the economy. I'll stop here.
Thank you, Siddharth. Thank you. Let's move on now to Arjun. Arjun is also the chief economist at Sundaram Mutuals. Arjun.
Thanks a lot, Professor. Thanks. Good evening, everyone. Thanks for having me on the call. I'll keep it short. So just 3-4 main points. So our base case view on the RBI monetary policy, it remains pretty much the same. We're expecting a continued pause at least until the February 2025 union budget. That continues to remain our base case. Now, on the Federal Reserve policy, now given that it's fairly relevant, we thought the Fed would actually cut in early 2025, but the rate cut has already started. So they've done 50 basis points. They're expecting another 50 this year, another 100 next year, and another 50 after that. So, but we continue to hold on to our view on a soft landing in the US, and we don't expect the RBI to be aggressive in its rate cut cycle. So when the RBI does start, probably after the February 2025 union budget, it would probably be a more shallower cycle than broad expectations. That was the first one. Second, I think the RBI will remain concerned around the trajectory of food inflation, and also will be preoccupied with global uncertainties around China stimulus, around the impact of that on India flows, and again the rupee as a result, ongoing geopolitical underpinnings, and finally the US election outcome. I think that will continue to take a fair bit of their mind space. While growth appears to be sort of holding up for India, when you look at short frequency indicators, they seem a bit mixed. There is normalization that is taking place in a number of indicators like credit growth. You're seeing some normalization there from its 15% odd levels. You're seeing some normalization in the PMI indices, but they're still well above 50. But when you look at PV and CV sales, they continue to remain fairly weak. And it seems to be rubbing off on a drop in diesel sales as well. Two-wheeler sales is expected to see some sort of a pickup with some underlying support from the festive season that's expected to be fairly positive. Also, given that the monsoons have been broadly okay. Tractor sales are witnessing some sort of a pickup and expected to see some momentum pickup going forward. So on the whole, I think this December quarter will be more like an inflection quarter for the RBI. So it gets a chance to sort of review its growth forecasts, and which are above what the markets have been expecting. And it will also help the RBI decide if it would need to start its rate cut cycle ahead of our expectation of Feb 25 or so. I think I'll stop.
Thank you, Indranil. Thank you a lot, Arjun. So as I understand now, we are in that sense divided. There are some of us who feel a rate cut is possible. Let me check if Abhik has joined. Abhik? Abhik has not joined. And 1 second, I just want to also check if Surjit Bhalla has joined. Okay, so we, Dr. Surjit Bhalla and Abhik have not joined. So we are a divided house. Some of us have a view whether we should recommend a cut. Others have a feeling that given this global uncertainty, what's happening in the Middle East and the climate, maybe the rate cut is not fully justified here. We are open to a few questions. We have about spare. Most happy to take any questions if anybody in the audience wants to ask a question, or from the industry wants to make an observation which we can capture while we send our inputs to the government.
So, Charan Singh ji, that
Right.
Reserve Bank Governor Saab has been mentioning that India policy on the rate cut or on the overall is on its own domestic consideration rather than international, particularly US Fed. So, those who have propagated the cut, just be, other than, of course, you have given other point, but what are their views on this aspect of RBI governor reiterating that we will go by the domestic consideration only? So, what is their view?
Sure, we can take a view around the table, but my own personal view is it is in domestic consideration itself that there should not be too much of a rate differential between the US and India. And the capital flow story is a genuine story. Most of us who have been at different places, both academic and policymaking, know the perils of capital movement. So therefore,
on that,
governor is
yes, sir. On
governor
that,
is
the debt market getting lot of flow that has been offsetting the if there are any outflow from the equity.
exactly.
So that has been, and we have a 700 billion US dollars of reserves.
Reserves.
So we are on the solid on that. You also mentioned 12 months of imports.
Import cover, yeah. So I think governor is right. And as you have seen, I don't think the world has, at least in my living memory, the world has been so protectionist as it is today. So governor is right. Our first and foremost priority is the domestic market, and keeping that domestic market in mind, sometimes the repo rate has to be held at some level or reduced at that level. So we'll go with governor's statement and the sentiments behind it. Okay, I would like to seek the views from my colleagues in the shadow if they have a view on this. Indranil or Upasana, Siddharth or Arjun on this governor statement?
No, I think I agree with you. See, while primary factors are always, or the dominant factors will always be domestic, but we are interlinked with the rest of the world. And, whatever happens globally does impact our asset classes, whether it's currency, whether it's rates. So we do have to keep into account all of that to ensure that financial stability is not at risk. So like Dr. Singh said, like for example, interest rate differentials, that also comes at play then because capital outflows could increase if, we start seeing interest rate differentials narrowing significantly. So somewhere there has to be a balance which has to be maintained. If domestically we are sound, everything is good. And if there's not too much volatility globally, then we can act independently. But if we are seeing sounds of, possibility of too much of volatility, then we'll have to be careful on that front. So I think that's how it is.
Thank you.
Indranil?
So I think, yeah, so I think that, the governor has said things both ways, which is only normal for a central bank governor. He has said that we are acting on, local factors at the same time. he has said that we cannot ignore the world. Now, obviously, when you hear a central bank say that we are fighting inflation when inflation is at 4 and below, when you hear a central bank say that it is fighting vegetable inflation, what do you infer? Can monetary policy plant crops? I would think the reverse is what people say, right? That we have to look at core, we cannot fight overall inflation. So I think it's very important to read between the lines. If any economist says that because there is a problem with the rain, the central bank should raise rates or not cut rates. So therefore, I think that, the governor has put things both ways. It's a complex world. Policy responses have to be complex. I think he has gone out of his way to identify that there is a global spillover issue, something Dr. Reddy never did during the last 2006 tightening. So, I would say that, the market should look at both the statements and understand his dilemma. When you are faced with a Fed, which in one policy says we will cut thrice, then it says we will cut once, then now it goes and cuts, and now it says it will cut 4 times. So the Fed is also living by, data point to data point, which is not something we have seen the Fed do in the past.
Okay, let me check if Siddharth or Arjun wants to contribute. Siddharth, do you have a view on this?
Maybe, sir, I'd just add to what Upasana and Indranil said. If I see going ahead, what is in store for us, and if we take 2 into 2, 4 scenarios. One is inflation becoming slightly more uncomfortable, or inflation giving us more comfort, and growth becoming slightly more uncomfortable, or growth continue to give us comfort. If these are the 4 outcomes and some combination of that, in most of the situation, you get to see that it's optimal in terms of a policy response on the part of the RBI at this moment to deliberately go a little slow in terms of delivering a rate cut at this moment. If inflation gives us more comfort at that time, we can cut. But if inflation springs a somewhat nasty surprise at this point of time, then it will be a bit of a problem for RBI. Same with the growth scenario. If there is a little more at this moment, the numbers are healthy. We can delay a cut a little more. Not that a lot of cut in the governor's armory at this moment. So they may choose to delay it a little more. They are not under any tremendous compulsion. That inflation has also not fallen dramatically. Growth has also not fallen dramatically. They are not under any tremendous compulsion at this moment. The point Indranil mentioned right in his opening comment of high real rate, it's a very, very valid. And at some point of time, if we get a sense that it's actually has started coming back and hitting the economy a little more, possibly they will start acting and at that point in time. Having said that, one of the narratives that they had flagged of neutral rate of 1.4 to 1.9 in one of their research papers. Going by that, if we take that, they would prefer to have some kind of a real rate somewhere in the range of 1.5 to 2%. That will not actually give them too much of legroom to cut if and when they start cutting rates. So we need to figure out that particular aspect also, that how exactly going ahead they guide us on that particular aspect.
Sure. Arjun?
Sure, Prof. I agree with all what everybody said. I lean towards a lot towards what Indranil was talking about. I think there's a lot of reading in between the lines, and in context, at least, I have a personal bias against an inflation targeting framework in a very explicit way. We had a multiple indicator approach where inflation was one of the variables that the RBI targeted. But post 2014, we've actually wedded ourselves to an inflation targeting framework, which means the central bank's narrative can't really say that inflation is not important at this point in time. Growth is of more importance. They can't really make those statements. So I feel the narrative from post 2014 always has to be consistent from an inflation focusing framework, which means then that any other situation that arises, any other priority that arises, they can't really explicitly say so, which means reading between the lines becomes extremely important. Now, on specifically to your question, I think we, like Ms. Bharadwaj was talking about, I think we are in a very globalized world. I think it's very, very true even today, where if US sneezes, the world catches the cold. It's very true. So our base case, I think there seems to be a very low possibility of a recession in the US. I think it's going to be only a soft landing. But if there is a very sharp growth drop in the United States, I think the RBI will be forced to cut aggressively. Given that that is not our base case scenario, it looks very likely that whatever rate cuts that the RBI will deliver will be fairly shallow and moderate in that sense. So to the extent of the RBI's rate cut, if there is global uncertainty and a very sharp drop in global growth, you will see a sharper rate cut from the RBI. If global growth holds up, rate cuts from the RBI might not be as sharp. It might be relatively shallow. I hope that answers.
Thank you.
Thank you, Arjun. So I think we have addressed this question. It's a very vital question. We are going to have a discussion on inflation targeting tomorrow at EGROW. Professor Dholakia will be chairing it and giving his views. We have Professor TCA Anand from Delhi School of Economics, a statistician, a well-known recognized statistician. And also we are going to have Mr. Sitikant Patnaik, who's now the chief economist at NABARD, but was the ED at the RBI till about, I think, 6 months back. And he has been working in the monetary policy department. So he'll be talking about inflation targeting tomorrow. My own personal view has always been that the inflation targeting regime needs to be revisited. At least the inflation target needs to be revisited. I have myself done some work at IM, and I found that the target is too artificially low, which strangulates growth, and because of which there is a sacrifice ratio which is very high on growth. As I repeatedly keep saying that India's potential of growth is around 9%. It is no reason to celebrate when we are at 6% or 7%. And we are at 6 and 7% because the interest rate is not where it should be. It's too high for comfort, too high for investment, and therefore investment keeps getting postponed all the time. So with this, I think we should conclude. Dr. Rajesh, we started a few minutes late, and I'm sorry we have exceeded 5 o'clock by 2 minutes. I hope that is okay. Back to you.
Yeah, thank you, sir. Thank you so much. Now I request Mr. Vasudev Mukherjee, please conclude the session, sir.
Thank you, Rajesh. It's been truly eye-opening session. We've had a lot of informed views during this roundtable, and we are going to be taking all of this into account as we finalize our recommendations for the RBI for the upcoming monetary policy. So I'd like to thank all the speakers and the participants for being here with us, and we look forward to seeing you during the next cycle of the monetary policy. So thank you once again.
Thank you. Thank you so much, sir.
Thank you.
Thanks a lot. Thank you.
Thank you.